Our lead story today is the narrative currently dominating every financial screen globally. Crypto bloodbath wipes out billions, but signs of stabilization emerge. This is more than a simple price drop. It is a critical stress test of the digital asset ecosystem, a stark reminder of its interconnectedness with global macro forces and a potential pivot point for institutional adoption. The initial bloodbath saw the total crypto market capitalization shed over a quarter of its value in a period of just 72 hours. While billions were liquidated, the subsequent emergence of stabilization signals the market's growing maturity and resilience against what would have been a catastrophic volatility just a few years ago. We're now seeing key technical and fundamental indicators flash a temporary holding pattern rather than a continued free fall. Now let's break down the two primary sources at play. The US stock market, particularly the tech-heavy NASDAQ and the S&P 500, is demonstrably correlated with major crypto assets like Bitcoin and Ethereum. The sell-off was not a crypto-native event, it was a global risk-off sentiment wave. The primary trigger for the initial crash, according to multiple analysts, was an escalation of geopolitical tensions, specifically new tariffs announced by the US on a massive tranche of Chinese technology imports. This immediately injected uncertainty into the global trade outlook, sending traditional investors scrambling for safe haven assets like the US dollar and treasury bonds, and selling risk assets across the board. The stabilization phase we are seeing is largely a function of the US dollar index, DXY, pausing its relentless ascent. When the dollar's strength cools, the high-risk assets, both tech stocks and crypto, typically get a moment to breathe. The lack of a further accelerated drop in crypto, even as the stock market remained turbulent, suggests key support levels are holding and the excess leverage has been flushed out. The severity of the drop was amplified by a massive cascading wave of leveraged liquidations. This is a technical detail that carries massive financial weight. Many retail and institutional traders use leverage borrowed funds to trade crypto. When the price dips suddenly, their collateral is no longer sufficient, leading exchanges to automatically liquidate their positions to pay back the loan. This forced selling snowballs, driving prices down further and faster than organic selling pressure alone. Billions in leveraged positions were wiped out. This high leverage event provides fresh ammunition for US regulators, specifically the SEC and CFTC, who are already scrutinizing the need for greater investor protection. The narrative of signs of stabilization is critical here, as it may preempt the most punitive regulatory actions. If the market shows it can self-correct, the argument for blanket restrictive rules weakens. Future legislation such as potential stablecoin regulation or clarity on digital asset classification will be heavily influenced by how the market crashes are perceived by Congress. Furthermore, the US Federal Reserve's stance on interest rates remains the ghost in the machine. A belief that the Fed may hold its aggressive rate hike cycle or pivot due to softening inflation is the most fundamental factor that could turn the stabilization into a sustained recovery. Crypto prices, like tech stocks, are highly sensitive to the perceived cost of capital. Now, we turn our attention to how this global financial tremor affects a key emerging market, South Africa. For South African crypto participants, the impact is layered, primarily filtered through the volatility of the rand. In South Africa, Bitcoin and other crypto assets are often used as a direct or indirect hedge against the rand's persistent weakness and high domestic inflation. When the global crypto price drops in US dollars, the immediate impact on a South African investor holding Bitcoin is often slightly mitigated by a corresponding weakening of the rand against the dollar. The global risk-off sentiment that hits Bitcoin also tends to weaken high beta emerging market currencies like the rand. This dual movement dampens the losses in rand terms compared to the purely dollar-based figures. However, it also means that the stabilization in dollar terms doesn't immediately translate into a major relief for the ZAR-denominated value. A unique factor in South Africa is the strict exchange control regulations. South Africans face legal limits on how much capital they can move offshore to purchase crypto. This limitation acts as a barrier, preventing domestic crypto whales from participating in the kind of mass liquidation seen in the US and Asian markets. This regulatory friction, while often frustrating for investors, may paradoxically provide a degree of insulation from the worst aspects of global volatility. Local exchanges often trade a premium or a higher price for Bitcoin compared to international markets, and this premium can be especially volatile during times of global stress. The primary effect on the average South African is one of sentiment. Following the collapse of local crypto firms like Mirror Trading International (MTI), confidence is fragile. A global bloodbath reinforces the public's perception of crypto as an extremely high-risk, speculative asset. This will likely slow down the pace of new retail adoption, especially among the risk-averse. The South African Reserve Bank, or SARB, and the Financial Sector Conduct Authority have been moving to formally regulate crypto assets, notably by declaring them a financial product under the Financial Advisory and Intermediary Services Act. This global crash and the subsequent stabilization will accelerate the push for regulatory finality in South Africa. The FSCA's primary goal is consumer protection and combating illicit financial flows. The recent volatility underscores the urgent need for a framework that mandates consumer disclosure, robust cybersecurity standards, and anti-money laundering controls for crypto asset service providers in the country. For a broader social impact, South Africa's high-cost remittance market is a critical use case for crypto. Extreme volatility, even with stabilization, makes using crypto for cross-border payments riskier for the average citizen sending money home. The global stabilization is a positive signal here, suggesting that the underlying technology remains viable and that the extreme volatility is being absorbed, which is essential for crypto to fulfill its promise of cheaper, faster financial inclusion for the large unbanked population. So what are the concrete signs of stabilization we are observing, and what should investors be watching for next? The first sign is the reset of funding rates across perpetual futures contracts. During a crash, funding rates, the cost to hold a long position, often go deeply negative, signaling overwhelming bearish sentiment. The return to a neutral or slightly positive funding rate suggests the short-term speculative leverage has been neutralized. Additionally, the drop in open interest, which is the total number of outstanding contracts, indicates the market is deleveraging, which is a necessary precursor for a healthy bottom. The rise in Bitcoin's relative dominance over altcoins is another stabilizing factor. During an extreme market fear, capital tends to consolidate in the most established, most liquid asset, Bitcoin. This capital flight from highly speculative altcoins back into Bitcoin suggests a flight to quality within the crypto ecosystem itself. On-chain data is beginning to show substantial wallet addresses, often referred to as whales, are quietly accumulating assets, treating the crash as a discount buying opportunity. The movement of coins from exchanges into private wallets reduces immediate selling pressure and signals long-term conviction. The volatility of the crypto market continues to be its defining characteristic, but this latest bloodbath carries a unique footnote: resilience. The speed at which the market absorbed the liquidations and found a temporary floor is a testament to its increasing maturity and the depth of institutional capital willing to step in. For our audience in the United States, watch the correlation with the NASDAQ and the regulatory responses coming out of Washington, D.C. For our viewers in South Africa, the key metric remains the rand-dollar exchange rate and the finalization of the local regulatory framework, which will ultimately dictate the legitimacy and security of the local industry. Thank you for joining us.